Well, yesterday, of course, the U.S. Federal Reserve Board cut its key interest rate by 25 basis points. That was expected. However, it also scaled back the number of cuts it sees in 2025 to 2. As Chair Jerome Powell said, future easing would require fresh progress on inflation. For more on the Fed's path forward, Thomas Hoenig is former vice president of the FDIC, one of the key regulatory agencies in the U.S. He's also former president of the Kansas City Federal Reserve. He's currently distinguished senior fellow at the Mercatus Center at George Mason University in Washington, D.C. Thomas, thanks a lot for joining us. So there was a big market reaction, of course, yesterday to the Fed's forward-looking view on rates. Should the market have been that surprised at only 2 rate cuts likely in 2025?
I don't think the market should have been, and I doubt if it was all that surprised by the fact that now they confirmed what has been talked about for some time, that inflation has ticked up. The economy is very strong. Real wages are climbing, and the economy is on a very strong path. And asset values have been extremely high because of low interest rates. So it shouldn't have been a surprise, but of course, when you disappoint the market, and they've been used to very low rates and keeping them there, and used to the idea of multiple cuts, then they react. And they did throw what I'll call a little bit of a market tantrum yesterday to show their displeasure. But I think they'll get by that. But we still have major issues with inflation, and that's really going to, I think, drive the future somewhat.
Interesting to hear you use the phrase major issues on inflation. Speak to us in more detail on that.
Well, first of all, you've had 2 instances where the inflation numbers have been somewhat surprising I think, to the Fed on the upside, especially this last time. And they were not expecting that. Obviously, they thought that when they came in September and they started to cut, they thought that inflation was pretty much on that trajectory down. And this has disappointed them and the markets, I think, to some extent, and changes the dynamics for the Federal Reserve going forward, as witnessed the fact that you had at least one dissent again at this meeting yesterday.
How likely is a Fed rate increase sometime in 2025? We spoke with a U.S. economist earlier today. She thinks that's possible.
Well, I think it's possible. Anything's possible if the inflation numbers stay high or rise, given all the uncertainties that we're facing in the United States going forward. I think it's unlikely in 2025, but if inflation continues to stay high or rises sharply, then of course they would almost be forced to reverse direction, and that would be a real shock to the market as well. So we'll have to wait and see. I think another part of this is the fact that their balance sheet is still coming down. There's a lot of debt to be financed. That's going to affect interest rates and especially the longer end of the yield curve. Those could all have a role to play in the future. So it's kind of an open field right now. And that, I think, is what the market was reacting to some extent yesterday, given that uncertainty drives markets down, and they certainly were driven down yesterday.
Is it time to pat the Fed on the back for engineering, or at least strongly contributing to a soft landing in the U.S. economy? It wasn't that long ago that the real concern of the markets was a U.S. recession. Well,
I think the recession likelihood is clearly less so, but I think the issue, no, you can't be patting anyone on the back when inflation is still that much higher than your target of 2%. When you have CPI going up, even the PCE up above that number, I don't think anyone wants to be patting themselves on the back just yet, and I think they know that. That's why they were very cautious in their words yesterday, and their projections actually show inflation increases. So they know they have some challenges ahead. So I don't think anyone's patting themselves on the back.
Okay.
No.
That's a fair point. What is your take on the U.S. labor market? That has been a source of at times unexpected strength this year.
Well, I think it is a strong market. People have talked about it. I think even the chairman yesterday was talking about they're seeing some slowdown in the labor market and this sort of thing. But the fact of the matter is, unemployment in the United States at 4.2% is full employment by most measures. And so we have a strong market. I think everyone expects it to stay strong unless inflation gets out of hand and they have to squeeze down again. But at the moment, no one's counting on that. I think they're hoping is maybe the word, to be able to get more cuts in. But I think that's probably less likely than ever. But I think we still have a strong labor market. Yes.
What is your view on the potential of very steep U.S. tariffs in a new in the income initiated by the incoming administration in Washington, and the influence or the pass-through to U.S. inflation?
Well, I think I take the tariffs and the promises of tariffs seriously. So I think we will have tariff increases. How much and who will all be affected, that's unclear. I mean, there's a lot of posturing here as they talk about it, tariffs. Now, I think tariffs are in fact more of a supply shock. So you will have inflation. It should not continue on unless for other reasons inflation goes up. But I think if tariffs would raise prices, but I don't think would maintain a higher level of inflation over time once the economy adjusted to the higher price level from the tariffs. So it's something that I'm concerned about because it does have effects, but it's not a long-term inflation factor, not anything like interest rates that are too low or something like that. And remember, if I can just add a little bit of difference, and that is, they keep talking about in the United States the neutral interest rate, what it is. But if you think about it, given the size of our debt, the kind of strength in our economy, the idea that the real equilibrium rate or neutral rate, as they like to call it, of 2% is possible. And if you then take that and consider what real rates are in the United States today, they're around 2%. So in that sense, we are at or even a little bit below the equilibrium rate, which is more stimulative. So that's another issue around inflation, every bit as important as the tariff outlook.
Thomas Hoenig, thank you a great deal for this conversation. He's former vice chairman at the FDIC and a former president of the Kansas City Federal Reserve.